Today's episode of Market Talk is brought to you in part by GrowMark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions board of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Wednesday, July 14th. I am your host, Jesse Allen. Great to have you here with us once again. You can find us online, markettalkag.com. That is our home on the web. Markettalkag.com is where you can find us. And, of course, find all our social media links, our streaming, and much more all online, markettalkag.com. We have a lot to talk about on today's show. Let's bring in our good friend Mike Zuzolo with Global Commodity Analytics joining us today. Mike, great to have you back on the show here for another week, another Wednesday, and a very nice update today. Maybe not so nice in the weather forecast coming up here for the next 7 to 10 days in the Northwestern Belt once again, but overall, seemed like some money flow coming back into our grain markets here on this Wednesday, Mike.
Yeah, I think the weather bears are probably out of position still since the USDA report, and the inflation bulls are probably jumping back in at this stage of the game because of some of our inflation data and also some of the trade data from China and some of their inflation data as well. And plus we have the ongoing movement of the Federal Reserve Chairman talking both Wednesday and Thursday to Congress, and I've been tuning into that most of the afternoon. And the gist of his commentary is very meaningful to the commodity sector as a whole and those inflation bulls, I think, Jesse, especially in light of the producer price index and consumer price index numbers we've seen this week. And that is, he is not in any hurry to taper or change the direction of this market. And I think that kind of reinvigorated the precious metals markets. I think it would have reinvigorated the crude oil market had we not seen an OPEC deal announced this morning. And most importantly, and we talk about this a lot between you and I, it was able to curtail the dollar from breaking above this key resistance level of 92.55. If I were doing a meeting or if I were going to talk to somebody for the first time and they wanted a couple bullet points of what to watch no matter what happens in the world, the dollar resistance level of 92.55 is a real critical level not to go above, in my opinion, because then it kind of suggests pretty strongly you're not in that inflationary wave anymore. So don't want to beat that drum too much, but I think it's really important to end this comment with these statistics. When you look at menu prices now after the consumer price index reading this week, menu prices year over year jumped about 4%. Or are 4% higher, June 21 versus June 20. That's the highest reading since 2010. PPI numbers came in at plus 7.3%. That's the highest since 2009, 2010. And for the consumer price indexes on an annualized basis, we're up 5.4% annualized. That's the highest since June of 2008. So between the 2009 menu prices for restaurants, between the 2010 levels for PPI, 2008 levels for CPI, you can kind of hone in on our talk between the model years of 2008, 2009, or 2011, 2012. It sure still looks a lot more like, to me, 08, 09 at this point.
That's a great thing you brought up there. I'm glad we led with that today because, again, a lot of this inflation data in the last couple of days really is going to affect our broader ag sector overall. And, of course, you know, the weather story is the thing that a lot of folks are is the trendy headline today outside of the inflation data. And, we saw corn up nicely, 17, 18 cents today. Soybeans led the way. Wheat futures higher as well. We'll get to wheat in a minute. It's a totally different story. But on the corn side, looking at us getting back above some of these levels, some of these support levels here, what is your thoughts on corn? And I know I got a couple charts of yours we can pull up as well, Mike.
Yeah, I think the key with corn is we finally attached. This is a July D's corn spread, and it's really timely because the July futures went off the board today. And it went off the board at about $1.15, $1.14 premium to the September, which is now going to be lead month. So this is the old crop, new crop spread, July D's from yesterday, which would be Tuesday. So we went up and made a brand new contract high in that July D's corn spread, in no small part due to the soft red wheat finally finding support off of the spring wheat, and also due to the continued drought in the plains and the Canadian prairies. I think what's nice to see about this spread, Jesse, is that between the Brazilian crop being lowered, and then this issue with the spring wheat, and this issue with the canola, and the fact that we're not getting any better, it's actually getting worse for those two crops specifically. We're finally getting the market to react fundamentally and have logic to it, where we're trying to run the old crop price up sharply in order to ration demand very quickly because of a tightness of stocks that the market now realizes we're under. And I said in no small part because of the wheat market, and that goes back to our conversations in the past months or so of the feed wheat market coming in and robbing and stealing demand away from the corn market. USDA's report, by what they did in the spring wheat sector, really takes that down in terms of a level of importance. And the USDA report also elevated the level of importance once again of the weather, and not just here in the United States, but in Europe and the Baltic regions, and even in China. This midday, I sent out a map to clients and subscribers about the 5-day precip outlook for northeastern China and eastern China. They're looking at 12 to 15 inches of rain in about 10 to 20% of their corn producing regions, soybean producing regions. And I think that really probably helped the market quite a bit on Wednesday.
Well, and I think as well, and with yesterday, we saw a little bit of that squeeze in the corn market on that July
Right.
contract too, and that was interesting to watch. And I know, I think when that expired, there were still some contracts open there taking delivery, and so that was another interesting note I saw there as well. And of course, I'm hearing some rumors out of North Dakota. I mean, we know how dry it is there. We know the problems with the spring wheat, but with corn, even some talk and rumors and whatnot of, if they don't get any rain in the next 10 to 14 days, there's not going to be much corn crop up there, Mike. And I don't know if that's what you're hearing as well.
It is, and I think you have to use the spring wheat as a springboard, probably a bad pun, but the spring wheat is a good springboard. Stop watching the good to excellent conditions at this point when it comes to the corn. Start watching the very poor conditions, because when you do that in the spring wheat, what you saw this week was very, very limited movement in the good to excellent, but the very poor conditions jumped 5 percentage points. We went from 50% very poor to 55% in 1 week, Jesse. And so we're talking about a situation where it's a catastrophe brewing up there in the spring wheat. And I agree with you. In 10 to 14 days, we could be talking about a catastrophe, or as I said last week to some of the other people I talked to and some of the clients I work with after the week's weather was out, it really does smell and feel a lot like 2012 in terms of the level of impact that region's going to maybe see in the corn and even soybeans, but corn especially. The level of impact they're going to see in their drought and the yields is going to be similar, I think, to what Illinois and Indiana felt in 2012. And I don't think the market is quite embracing that yet. I think they're just now getting their arms around it. But I don't think they would have had it not been for the USDA report until, like 2012, we literally saw USDA cutting yields by 12, 15 bushels to the acre in more than 1 month. So I think the crop in spring wheat and corn and canola can and will get worse in 10 days, and that can continue to help support this market. And that really drives back to that July D's corn spread and what the new crop corn can do, because is the $1.14 or $1.15 difference between July and September going to be a situation where we now will have a gap on the chart, in the weekly chart, to the upside now that the September is so cheap compared to the July? Are the funds in the market going to try and fill that gap and lead the September and that early new crop market up to levels that no one thought possible before the USDA report? And I think that's a real viable potential, something certainly to look out for. And that gives you the opportunity to hedge new crop corn then.
Very, very true. And, since we brought up spring wheat quite a bit there, I know you have this chart as well, looking at the spring wheat futures. And obviously, if we're looking at the catastrophe and the problems up there that we do have in the Canadian prairies and the northern belt, one's going to have to wonder how much of a crop is there to market. But I feel like there is a lot of potential in this spring wheat market right now for this to break out even more to the high side if all of this comes to fruition with just how little of a crop there could be.
Yeah, I mean, when you look at the fact that spring wheat is responsible for about 30% of the total wheat production, I think you and I hit this very hard last week about what is spring wheat production, because we didn't know. We were blind until the report this week. USDA hadn't given us figures. So after looking at USDA's figure, I can put a similar chart pattern together, or mindset, or analysis, or model year, much like I did with the 0809 for corn, as far as 2010, 2011, when it comes to the spring wheat and how it may impact the soft red wheat and also the hard red wheat. And I think this is especially pertinent now that we're through the 50% mark on winter wheat harvest. And what you see in the blue circle to the far left is how the spring wheat literally led the soft red wheat up. And I don't want to say kicking and screaming, but it was pretty much kicking and screaming, because I remember that. And I remember that was a time period when a lot of people were trading spring wheat, soft red wheat spreads, and they got their head handed to them because they're on the exact wrong side of the market. They were long the soft and short the spring, and the spring wheat just went crazy, or they were short soft red and they couldn't figure out why the spring wheat was able to drive the soft red higher. And so what you see there in early 2011 is the spring wheat going straight up, and then the soft red finally wanting to follow it. And then you put a big high in the spring wheat, and notice how the soft red just went straight, pretty much straight down in nice waves after the third quarter of 2011. And that eventually capped and put a high in for the spring wheat. Take your eyes now over to the far right of the chart, and you've got an 867. Again, this is as of Tuesday's price. 867 spring wheat futures versus a 629 soft red wheat futures. Notice the difference in trend, though. This soft red wheat has been going straight down, essentially, in purple, and the black line, the spring wheat, has been going straight up. I think that report is going to have to rectify this, and that the soft red wheat will be pulled up by the spring wheat for a time, again, because the feed quantity may be ample, but the food grade quality is going to be very tight, and they're probably going to do a lot more blending. And I think soft red and hard red wheat can find some support off of this in the next 30, 45 days. I wouldn't time it out any more than that, because there's a lot of differences between 2010, 11 and versus what we're dealing with right now. So I like to look at like a 30, 45 day horizon in this chart.
And Mike, on the soybean side as well, obviously we know we have some more time with the soybean crop. That's, typically made in August, but still facing some of the same weather issues in that western, northwestern belt. Soybeans, though, bean oil, canola, the edible oils market remaining strong. Soybeans today were the leader on the futures side. So what are your thoughts on the soybean market here as we've gotten out of the report? Now we're starting to build weather premium back in.
Yeah, this is where I think the corn has more upside potential because of the beans in part. So I think corn has wheat and soybeans on its side, and because beans really didn't get a good report. I mean, if you really want to look at the bean report, yeah, we still only have about 3% stocks to use ratio here in the United States, but we've got 25% stocks to use ratio in the world right now. And I think most of us in the market don't believe that the Brazilian bean crop is going to come down. I think the Argentine crop can come down, Jesse, maybe 1.5 to 2 million tons. But I think the Brazilian bean crop is there at this stage of the game. So you've got a situation where U.S.-China negotiations and trade policy and frictions are going up. You've got a very strong competitor in South America, especially from a currency standpoint, because their inflation's so high, their currency's so weak. You got a situation where the fundamentals are really based upon, in terms of why the soybeans are going up, are based upon canola and the vegetable oil market, and also based upon just the outright fear that the U.S. crop is very, very poor. If it weren't for that 50.9 yield, I would be hedging beans right now. But I had two clients in Illinois, about 100 miles away from each other, call me today and say, I want to buy beans because this is one of the worst crops I've ever had. And I think what's happened here in the bean crop in the central corn belt and the western corn belt was we put a lot of beans in super early, expecting them to do very, very well like they have the past couple, 3 years. But this year they did not do well. They're very short, and they're very exposed to damage, either of too much heat or too much water. So I'm going to ride this market a little bit because of the vegetable oil market and the canola crop and what we're seeing in Canada. But I'm still a hedger in the soybeans. And I told both clients, I said, the best thing to do, I think, is get into puts, roll those puts up, but don't get long here unless you're really only looking at like a 4 or 5 day time horizon and you just want to try and pick a high or pick a low. And I don't do that. I'm a hedger. I'm not a speculator. So I really like the puts and the beans. That's what I've been in ever since, 2 months ago, roughly. And I think that's still the way to go because that yield is still wide open.
Mike, I want to make sure we have time to touch on this as well. I've been seeing some talk and chatter on social media and Twitter and whatnot here in recent days, and I thought this was kind of pertinent to talk about. Is that Brazil safrinha crop, that
Mm.
corn crop? We know there's issues down there, yet it seems like a lot of folks have kind of stopped talking about it in this market. We obviously saw the reduction on Monday's report from the USDA, but a lot of folks still thinking we got to come down more. And how's that going to play into our balance sheets? What are you hearing from some of your sources in Brazil? Because I would agree. I feel like it's almost kind of been a story that's been thrown to the wayside as we're looking at U.S. weather.
Yeah, this fits perfectly into our discussion so far, Jesse. I really do think it goes back to the wheat market because the USDA Ag Attaché did a China update about a week or so ago. Can't remember if it was livestock or feed, but he talked specifically about for the better part of the last month, the Chinese have been buying more wheat, and especially from Australia, of all places, because they're in kind of a tough trade war issue between those two countries. But they've been buying a lot of feed wheat. The rest of Asia has been buying a lot of feed wheat, and it's really put the cap on the corn market. So that's, I think, point number one is the end user, the global end user especially, needs to come off the sidelines and come off the fence and start buying again. I think point number two, and this is what I think is probably the most indicative of how bad that crop is. I think it's bad. I think it's probably closer to 90. I don't know if it's below 90, but I think it's closer to 90 million tons. That would be 3 million less than what USDA just gave us. That's a big number when you're talking about tight global stocks. World corn stocks right now are running about 24.5, 24.6%. That doesn't sound like it's really tight, but historically, that's a fairly tight number. So if Brazil drops another 3 million tons, what should happen? Well, Brazil's price should go up at the port, shouldn't it? Well, that's not what's happened yet, except this past week. I did some digging, and it looked like we've gone from about $240 a ton to $260 a ton just in the last 7 or 8 days. U.S. Gulf prices after this big rally on Tuesday was up to around $285 a ton. So now we're starting to see the Brazilian price escalate, and I think that's going to continue. And if that's the case, end users would, I think, psychologically say, the low's in. I'm not going to get it any cheaper, and I know I got to get it on the water in the next 30 days. I better get some corn bought here before I have to pay 10 or 15 or 20% more than what I was expecting. So I'd be looking for that here in the next 10 days for end users to really come in and start buying. We've not seen any of those big daily export sales reports, that have been flashes by the USDA from China or Mexico. And I think this all goes back to the end user and the feed wheat and waiting for the USDA report, waiting for the rains in the United States. So I think all things are coming together here in the next 5 to 10 days. We should see the end users come off the fence. That should bring Brazil back into the spotlight, in my opinion.
Well, Mike, I want to make sure we hit livestock here as well before we run out of time. We haven't spent much time on that today, but cattle and hogs, both markets seemingly found a little early week support, and then today we were kind of so-so. Anything you're seeing throughout cattle and or hogs that we need to pay attention to here this week?
Yeah, I think they're kind of trapped, both of them at this point, trapped from a standpoint of the funds being in them and trapped from a standpoint of the fundamentals of the menu prices that I talked about at the top of the show. And just the consumer demand probably really getting hit right now between the gas prices, food prices, house prices, whatever prices you're talking about. Most consumption is getting hit very hard right now. And I think that's going to end up being an issue in the restaurants and in the grocery stores, Jesse. However, I think while the demand side is weak, and this may be familiar listening or familiar words from our previous discussions, supplies are coming down. And I saw USDA cut by 400 million pounds the 2022 pork production number. So hogs at $100, $105 in the deferred contracts seemed very high to me before the USDA report. They don't seem so high after that kind of a big cut. Similarly, in the beef side, we've seen now another big cut week over week on dressed weights. I think it was down 3 pounds this past week. That takes us down 23 pounds versus year ago levels. So I think we're very current in the cattle market. I think we're very current in the hog market. So I think we're kind of trapped between weakening demand and falling supply. Now, one of the two things on the cattle market, real briefly, there's a big disconnect in the futures market. Feeder futures before Wednesday were running $5-7 premium to the Oklahoma City cash price, while cash fat cattle were running $3 to $4 premium to the August fat cattle price. So it looks a lot better of a hedge to go after feeders, given the futures premium, and just stay current on your fat cattle marketings in the cash market.
Well, Mike, great insight as always into what's going on in the ag commodities and more. And of course, I know if folks need a little advice, which they very well might need some in these wild, volatile times, they could reach out to you. And you have a great free trial of the newsletter and more on your website, don't you?
Yes, please go to globalcomresearch.com. It's globalcom with 2 M's, research.com. Send you a 2 to 3 week trial, depending on what you'd like. And at the end of the trial, I'll contact you once to let you know if you like it. You can get a hold of me anytime during the trial. Feel free to do that. It's free, and we won't be pestered or bothered after that initial phone call.
Well, Mike, I appreciate the time as always. Again, his website, globalcomresearch.com. Mike Zuzolo with Global Commodity Analytics. Thanks again, as always. We'll talk to you next week, sir.
Thanks, Jesse.
Mike Zuzolo with Global Commodity Analytics, our guest today here on Market Talk, brought to you by GrowMark FS. Find us online, markettalkag.com. This has been the Wednesday, July 14th edition of the show. I'm Jesse Allen, wishing you a great afternoon.